We're seeing a number of voices then, Luke, coming out and saying, hang on, maybe we need to see something a little more dramatic from the Fed. Do you see arguments around the need for some sort of maybe shock therapy for markets, some shock and awe in the shape of larger interest rate hikes than perhaps we've become used to in recent rate hiking cycles?
The Fed says, and I think everybody would recognize, they need to do something about inflation. An awful lot of people have forgotten the transmission mechanism. Raising rates doesn't get rid of inflation on its own accord. The point about raising rates, you go back to Volcker. I'm old enough to have been around when he was doing his thing and to have spent time with him. And the point was he moved rates far enough to cause a significant contraction. That's how you get rid of inflation. The increase in rates causes the contraction. The contraction is what reduces forward-looking inflation. So the question this year is going to be a constant sort of trade-off between whether the market believes that the Fed and the other central banks have really got the gumption to raise rates aggressively enough to actually reduce forward demand and therefore forward inflation. My own guess is you're going to get a series of these windows where the Fed is giving strong messages, the market gets sort of caught up in the idea, oh, you get a push up in rates, and then what happens is you get a sell-off in equities, and then you'll suddenly find that they're not sounding quite as punchy as they used to, and suddenly you'll get a bit of backing off, and then things will feel okay. And you're going to get this sort of stop-start to how aggressive the Fed is going to be.
And
to get rid of inflation, they would have to be a lot more aggressive than they've shown any sign, and given the nature of central bankers as politicians these days, it'd be a surprise if they're really aggressive enough.
Why do you think central bankers are not more willing to make those bold calls, Luke? Is it because they're mindful of the feedback loop between equities and the real economy, or is it for other reasons?
Well, it's partly about that feedback loop, but it's a lot of it is about, we've lived in an easy money world for a long time. That's led to politicians believing that they can keep printing money in one form or another, or the central bank will do it for them. And central bankers have, had a pretty easy ride of it. And so we've ended up with a situation where I don't think Volcker could get elected as chair of the Fed today. I mean, obviously not literally him, but somebody like him. He was a pretty peculiar character. And, he was quite happy to talk about the need for unemployment in order to get inflation down. I don't see any central bankers or politicians being willing today to talk about, if you want to get that inflation out, what you've got to do is create a significant reduction in demand, which is really about creating a recession, which would be bad for equities. But, we're sort of stuck in likely a version of kicking the can down the road.
How will you be keeping the right side of technology trades then, Luke, as we go through 2022, given how stretched valuations look in some areas, but also the pivotal role that tech names play in our economy these days?
Sure. I think one has to avoid confusion between tech and forward earnings companies. So, if you look at Apple, it's a tech stock, but they earn a lot of money today, and the present value of the cash flows from Apple doesn't look very different if you've got interest rates at 10 years at 1% or you've got 10 years at 3%. It looks a bit different, but not that different. The real thing you've got is we've been through a world when interest rates have been so low that a cash flow today is worth basically, or has been valued, basically the same as a cash flow in 10 years' time. That, if you've got a company that only starts earning interesting profits 5, 7, 8 years away, is a very significant thing. And I think we're seeing that unwind. Now, what that does is mean there is more of a focus on earnings. I'm not sure, we've seen a little bump where it's anti-growth, pro-value. I think over time, once the sort of froth is out of that, you get to something that's more about quality. It's more about consistency of earnings, which is what's likely to be the thing. But we're going to get significant factor rotations while we try and work out new leadership.